we're on the cusp of the breakout where gold can go up to 5,000. I think the dollar is getting near its peak. The dollar's rallied ahead, and once you see that dollar reversal, once gold gets above 2,000, you could really start to see it take off. I mean, it's basically been dead since 2011. I think that's going to change. We've seen a tremendous rally since October. So the gold is the next thing I'm looking to add, and exactly in what form and how in my model portfolios across the board. That's something I was waiting for this print to figure out what I was going to do going forward. It's something that I'll be addressing over the next week. And then I'll own staples, utilities, energy, and healthcare. Your defensive sectors combined with cash, gold, and the long bond. Okay.
I just want to come back to something here. So you're saying that gold is going to go to $5,000 over a period of what? Not this year, I'm assuming.
So I think the way that you saw gold move in the last market, where you got more than a double from, say, 2007 to 2011, you could see a similar type move here, right? In that you have a 3 to 5 year period where once it breaks out previous highs, then it just takes off and we don't look back. Considering the amount of money we printed, okay, I have no idea why gold is not above 4,000 right now. All right. I mean, the statistic of the number of dollars we printed since March of 2020, it's like 40% of all dollars or 50% of all dollars ever created. And it's not like it only happened in America. It's happened worldwide, and we still have the best balance sheet out of everyone else. So why hasn't gold worked? I think, and I'm hoping as an owner of physical gold that we see this breakout now. Right. Yeah. Because once it breaks out, then you start to get the momentum players behind it. All the gold bugs that, disappeared in the last decade reappear, start pushing it. And so I think we are going to get a breakout. And if we do get a breakout, it'll tend to be meaningful.
You said your long duration. Are you assuming then that interest rates are about to peak this year?
So I think you've probably seen a peak in the 10-year and the 30-year. We might see the front end. So the 6-month treasuries were at 4.8%, 4.7%, where the front end is more 4.25%, 4.30%, like the immediate front end. And then so I'd say the 10-year and 30-year, the long end of the curve, rallies hard this year as we enter a recessionary period in anticipation of the Fed cutting. So the difference between the 2's 10 years is inverted now. I don't know that exact number. Again, I'd have to look that up. But we have a 2's 30 years inverted. And the 2's 30-year relationship is the bond market's expectation of inflation plus growth over the next 7 years. Why 7 years? Because you get a recession on average once every 6 years. So you combine the contraction that we're going to go through right now. We are at kind of one of the most inverted periods. And during those inverted periods, if you buy the long bond, as the front end's going to come down, it typically rallies because you have your short end up here, you have your long end up here, and what you have is both of them typically come down. And so I think a duration is going to work this year because last year, and historically, whenever you have a bad year in bonds, the next year is pretty good. So last year was the worst year for bonds on record. I can't see the Fed raising another 400 basis points this year like they did last year, or 500. So maybe we get another 100 or 125 basis points, but that's the front end. That's the Fed funds rate, not the 10-year, not the 30-year. So I own TLT. I think that's going to be a good trade this year, and it's going to work out along with gold.
So you said, just to finish up here. So you said that you think we're going to have a recession this year, is what you just said. Well, everyone's watching this probably wondering how to invest during a recession. You already gave the sectors that you are most comfortable investing in right now, but just give us some historical context, Mike. During recessions, typically, which sectors do best? Where does capital rotate to? Yeah,
great question. So we'll just use the last one. So gold performed extremely well in 2008. The S&P 500 was down 35%. TLT was up 34%. Okay, that is the long bond ETF. Historically, the defensive sectors have done very well. So XLP, which is consumer staples, XLV, which is healthcare, XLU, which is utilities. So these are the sectors I have exposure to. I had a lot of exposure to energy. I think it was 25% of my portfolio from January until November of last year. I'm at 15% in XLE. I'm going to be cutting that down simply because of the volatility on a risk-adjusted returns. But the expectation is that XLE and then energy is going to perform extraordinarily well when China leaves lockdown and they come back online, creating a real supply-demand problems. I'm not as bullish on energy as I was. I will own some of it, but from an equity standpoint, my major equity position will be XLP.